Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Intel stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Intel is a semiconductor chip designer and manufacturer. It has the most revenue of all the semiconductor companies. It develops the x86 series of microprocessors, which are found in most PCs. It supplies microprocessors for computer system manufacturers such as Lenovo, HP, and Dell. The company had a record year in terms of revenue in 2021. Actually, this is now 6 straight years of record revenues. Its subsidiary Mobileye also had a record revenue year in 2021. It plans to take that company public this year. Mobileye is an Israeli company that develops self-driving cars and advanced driver assistance systems. In 2017, Intel paid $15.3 billion to acquire them, which is the largest acquisition of an Israeli company. Intel is currently looking to acquire Tower Semiconductor for $6 billion. Tower is an Israeli semiconductor manufacturer. This acquisition will help Intel compete head-on with Taiwan Semiconductor. Intel manufactures motherboard chipsets, network interface controllers, integrated circuits, flash memory, graphic chips, embedded processors, and other devices related to communications and computing. It was an early developer of SRAM and DRAM memory chips, which represented the majority of its business until 1981. Although Intel created the world's first commercial microprocessor in 1971, it was not until the success of the PC that this became its primary business. During the 1990s, Intel invested heavily in new microprocessor designs, fostering the rapid growth of the computer industry. During this period, Intel became the dominant supplier of microprocessors for PCs and was known for aggressive and anti-competitive tactics in defense of its market position, mostly against advanced micro devices, as well as a struggle of Microsoft for control over the direction of the PC industry. The company's new CEO started in February of 2021. He said the company will reclaim its technology lead by 2025, also mentioning it could triple or quadruple in value. It sells most of the chips for all laptops. Intel's latest server chips are a big improvement, but AMD still holds a lead in that area. Intel has been slow to react to a power shift toward foundries, like Taiwan Semiconductor. Taiwan Semiconductor is no mere order taker. Its margins are much higher than AMD and Intel, so Intel has been waging a two-front battle on designs and manufacturing. Taiwan Semiconductor only manufactures chips for other semiconductor companies, but its market cap is triple Intel's. A decade ago, Intel was worth $118 billion, $40 billion more than Taiwan Semiconductor, Nvidia, and AMD combined. Now Intel is valued at $200 billion, but the other three companies are worth $1.4 trillion combined. Nvidia is the world's largest fabless company, and Taiwan Semiconductor is the world's largest foundry. The company's CEO says he will lean in part on outside foundries for now, while building a foundry operation that will serve other chip makers. It is currently building 2 manufacturing plants in the US for $20 billion. The company is headquartered in Santa Clara, California, and was founded in 1968. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, Zicha, Vienna, Swiss, Colombia, Santiago, Brussels, Kazakhstan, Sao Paulo, Lima, Buenos Aires, Hong Kong, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 196 billion market cap. They're trading at $48 a share, and they have 4.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2021, they had almost $10 billion of free cash flow, and that was their worst year. They had over $20 billion in 2020. The reason it was low in 2021 is because they're spending a lot in building out those 2 new factories. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's around $20 billion a year. Revenue is a sales for the company, and that goes up every single year, close to $80 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to manufacture the chips and wafer boards are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. That was the highest in 2021 at $43.8 billion. Below that is their operating expenses. Their main operating expenses are R&D and marketing. Below that is their operating income, which is pretty consistent year to year, around $22 to $24 billion. They paid $600 million of interest on their debt, which is lower than 2020 but higher than 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of something in this category is a gain on the sale of an asset. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is pretty consistent year to year. A really solid income statement. This is the company's income statement from the latest 10K. This is 2019, 2020, and 2021. The top line is the revenue. That was $79 billion. The country with the most revenue is China, then Singapore, then the US. And Taiwan is also pretty big as well. And all other countries is $16 billion. So their revenue improved the most in all other countries. It's actually declining in the United States, which is interesting. Below revenue is the cost of revenue. That was $35 billion. Then their gross profit, which is $44 billion. Their gross margins are 55%, which is better than the median and average of their industry. But their net margins are 25%, which is a lot better than the median and average of the industry. Intel does have better gross margins than Taiwan Semiconductor, but a lot worse than Nvidia. But Taiwan Semiconductor has pretty low operating expenses because they don't spend nearly as much as Nvidia and Intel in R&D and marketing. Taiwan has much better net margins than Intel, a little better than Nvidia. They spend a lot in R&D, research and development, $15 billion. R&D is obtaining new knowledge to improve existing products and introduce new ones. Part of R&D expenses are payroll, also depreciation and amortization. R&D is expensed, which means it goes straight to the income statement. It's not carried on the balance sheet and depreciated, like for a fixed asset like a building. Although I think it should be carried on the balance sheet and depreciated. They spend $6.5 million in selling, general and administrative, $2.6 billion in restructuring. So their operating income is $19 billion. They pass through lots of gains on equity investments. If a company owns 20% to 50% of another company, then they usually use equity method accounting, which means they report that company's gains or losses onto their income statement. Their net income is lower in 2021. It's mainly from the restructuring charges. Restructuring charges are one-time charges to reorganize part of the business. So it's a short-term expense meant to boost profitability in the future. This is their statement of cash flows, and the top line is operating cash flow. That's how much cash the company generates from its operational business. So this is the cash that's remaining after paying all your day-to-day expenses. And that's nearly $30 billion, which is lower than 2020 of $35 billion. And they spent a lot in CapEx, over $20 billion in 2021. Mainly on those two manufacturing facilities they're building in the US. Operating cash flow minus CapEx gives you your free cash flow. And that was $10 billion, which is half of 2020, but still plenty to cover its dividend payment. Not only do they pay a dividend, they also buy back stock. Every year they buy back stock, $10 billion, $14 billion, $14 billion, and $2.5 billion. When a company buys back common stock, it decreases the shares outstanding, making your shares more valuable. And they have been increasing their debt each year. Especially in 2020, they added over $10 billion of debt, paid down $4.5 billion. This is the company's operating cash flows. This is directly from their statement of cash flows on their 10K. And the way you calculate operating cash flow, you start with your net income, that was $20 billion. Then we have to add or subtract the non-cash items on the income statement. We have to add back $10 billion of depreciation, $2 billion of stock-based compensation, $2.6 billion of restructuring, $1.8 billion of intangibles, and they pass through that gain on equity investments. so we have to minus that out. They passed through a gain of $2.7 billion on equity investments on their income statement. The reason we're only minusing out $1.5 billion because you can't minus out the dividends you receive because that is a cash item. And then we have to adjust for changes in working capital. So it looks like they're extending $2.7 billion of credit. That's when you sell a product or service, but you don't receive any money for it, but you should receive it in the future. They bought $2.3 billion of inventory, so it looks like they're stocking up. Prior years, it was much less inventory outflow. They took on $1.2 billion of accounts payable, and they had a cash outflow of $1.6 billion on customer supply agreements. Even though they reported an accounting profit of $20 billion, they actually generated $30 billion of cash flow. My two favorite numbers to look at are revenue and operating cash flow. So you can see their revenue looks great from 2015 up through 2021. It's been increasing. Their operating cash flow has also been increasing. It did decrease in 2021, mainly due to that large CapEx expense, but that's a one-time item that should lead to greater cash flow in the future. The forecast is for their revenue to come down a little in 2023, then come up in 2024. And it looks like the forecast for their operating cash flow is to be pretty flat for the next few years. This is their investing and financing sections from their statement of cash flows, 2019, 2020, and 2021. Their investment in property, plant, and equipment is the highest ever at $19 billion. And they purchase and sell a lot of short-term investments. So in their investing section, they had a cash outflow of $25 billion. In their financing section, they took on $5 billion of debt. They paid down $2.5 billion of debt. They added $1 billion of common stock. They bought back $2.5 billion of common stock and paid over $5.6 billion of dividend payments. So in their financing section, they had a cash outflow of $6 billion. Last year was a cash outflow of $13 billion, mainly because they bought back so much common stock last year and the year before. This is the equity section on their 12/31 balance sheet. They have $95 billion of equity. They raised $28 billion from selling their business, and they profited $68 billion from running their business. Let's look at the capital structure. $95 billion of equity, $38 billion of debt. They're 71% equity, 29% debt. And they could pay off a lot of the debt with the cash on their balance sheet. If they used all the cash to pay down their debt, they would have $10 billion of debt left over. This is the equity. The red line is the debt, and the green line is the cash since 2015. And you can see their equity balance has been increasing while their debt has been increasing at a slower rate. That's what you want to see. You want to see that gap widen. They have lots of cash on their balance sheet, so they can pay off most of the debt with the cash they have. Of course, they don't want to do that. You want to keep a good amount of cash in case you need it for acquisitions or to run your business. This is a picture of their balance sheet. They have $64 billion of physical assets. These are equipment and facilities. $56 billion of long-term. This is mostly intangibles. They have lots of cash. So you can see their debt is pretty small relative to the entire right side of the balance sheet. That's what you want to see. You want to see the equity as the biggest box of these four, which it is. I gave them the highest whack on Finbox to be conservative, 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $238 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $234 billion. We divide that by 4.1 billion shares, and we get a calculated stock price of $57. They're trading at $48, so they're trading at a 16% discount. It's a buy according to the model. I grew their revenue 5% for the next 4 years. That's how I got their future revenue estimates. And to get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and divided by these 4 revenue numbers. And that comes out to 21%, so I multiplied their future revenue estimates by 21%. That's how I got their future free cash flows, which are all lower than 2020's number, so I think it's a reasonable estimate. I do think Intel deserves to be around $80, $90 a share, but I don't think it's going to get there for a while. High 50s, low 60s is a reasonable price target for this company. Simply, Wall Street values the company at 126, which is not going to happen. They're saying it's 62% undervalued. 20 analysts price this stock, and the low is 40, the high is 72, the average is 55. This is where the stock has been trading the last 2 years, so you can see it's been up and down. It actually hit about $70 just a few months ago. But there's so much demand for semiconductors And this company has the longest history and the highest revenue, so they definitely deserve to be as high as Nvidia. But I'm not sure if that's going to happen. They pay a consistent dividend each year. They're up to 37 cents a share, which is a yield of 3%. To calculate the yield, multiply the last dividend payment by 4, take that number and divide by the stock price. And it's only 30% of their net income, 62% of their free cash flow. Since 2011, they've been increasing their dividend little by little each year. And the projection is for them to keep increasing it. Of course, the yield is more volatile because it's pegged off of the stock price. The higher the stock price, the lower the yield. The lower the stock price, the higher the yield. It was over 4% at one point, but it mainly trades between 3 and 4%. But if you invest in Nvidia, they pay almost no dividend. It's really small. Their employee count has been pretty steady the past few years. It's up a little bit, but not too much. They have 121,000 workers. They have a pretty low beta, 0.54, so that does indicate the stock is not volatile. It's gone down 24% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 46, the high is 68. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Well over 30 million shares are traded each day. All the shares outstanding are on float. 65% are held by institutions and 1.5% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $24,000 today. That's only 9% annual return. But if you look at a company like Nvidia or Taiwan Semiconductor, you could have made a ton of money in the past 10 years. In the past 12 months, there's been only insider buying, no selling, so that's something you want to see. All the buying occurred in October. That's when it was below $50 a share. 64% of the shares are held by institutions and 36% by the general public. The biggest shareholder is Vanguard at 8.35%, 340 million shares valued at $16.2 billion. Then BlackRock, State Street, Capital Research, and Geode. Let's look at their financial ratios. They have an amazing PE below 10. That's stock price over earnings per share. That means investors are paying $10 for $1 of earnings. Price of sales of 2.5, which is also good. And a good price to book of 2.1. That's stock price over book value per share. Let's look at their non-current assets. $63 billion of property, plant, and equipment. $6.3 billion of equity investments. These are their investments in other companies. $27 billion of goodwill. Goodwill is the premium you pay when you acquire another company. $7.3 billion of other intangible assets. This may be patents or trademarks. And $6 billion of other. They have a really good return on invested capital of 17%. They can cover their interest payments 37 times. A solid ROE of 21%. That's net income over equity. So they provide great value to their equity holders. They can cover their current liabilities with their current assets more than 2 times, and their quick ratio is 1.7. Let's look at their current assets. $5 billion of cash, $2 billion of short-term investments. Trading assets are usually low-risk investments. $5 billion of corporate debt, $12.5 billion of government debt, and $3.7 billion of financial instruments. This includes swaps and hedges. They have $9.5 billion of accounts receivables. This is how much money other companies owe Intel. $11 billion of inventory. $6.9 billion of assets held for sale. The $6.9 billion is related to their NAND wafers. NAND stands for not and. That's just computer logic. And that $6.9 billion consists of $6 billion of PP&E and $1 billion of inventory. When something is in the bucket assets held for sale, that means the company is planning on selling those assets. Since it is a current asset, the sale should be within the next 12 months, and $2 billion of other. Let's look at their current liabilities. $4.5 billion of debt, $5.7 billion of accounts payable. This is how much money Intel owes other companies. $4.5 billion of accrued compensation and benefits. This is how much money Intel owes its employees, and $12.5 billion of other. They generated $10 billion of free cash flow in 2021. They have $30 billion of working capital, and they paid out $6 billion of dividend payments. So they have $34 billion of funding. So the company is well capitalized. The best way to look at ratios is to compare them to companies in the same industry. There are 68 companies in the same industry as Intel. Intel spends a lot on CapEx. The only company that spends more is Taiwan Semiconductor. They have a better debt to equity ratio than the average company. They pay the highest dividend of the semiconductor companies. They generate lots of free cash flow, but it was a little lower in 2021. Last year was $20 billion, which would have crushed everybody else. Their fourth highest in market cap. Ratios are a good way to compare companies since companies have different market caps. It's not fair to compare a company with 100 billion and 600 billion. So Intel is the best deal by far. They have a much better price to book, price to earnings, price to free cash flow, and price to sales. But why do they have such a good price to earnings ratio? Because people are not investing in this company like they are Nvidia. They really push up the stock price for Nvidia. I recently bought Intel, so I hope the stock price gets pushed up, because I think it should. They generate more revenue than any other company by far. They're not growing though. Their 3-year annual growth rate is only 4%. The average is 8%. Nvidia is 25%. But it's a lot easier to grow at 25% when your revenue was Nvidia's size compared to Intel. They have a much better ROA and ROE than the average company. So to summarize, I have them trading at a 16% discount. And I've been saying for a while, this stock is really undervalued. And I think it's closer to 40 to 50% undervalued. But I gave them a higher whack and I limited their revenue growth just because it doesn't seem like the stock price moves that much. I think it's just a matter of time till their market cap is similar to Nvidia and Taiwan Semiconductor in the $600 billion range. I ranked their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.